Look, I need to show you something that's happening right now in the gold market that most people are completely missing. And when I say most people, I mean the vast majority of investors who are about to watch one of the biggest wealth transfers in modern history happen right in front of them without understanding what they're seeing. Right now, as we speak, there's a pattern developing in the gold market that we've only seen twice before in the last 50 years. And both times, the people who recognized it early made generational wealth. The people who didn't, they spent the next decade watching their purchasing power evaporate while wondering what happened. Let me paint you a picture of what's actually going on beneath the surface of these markets. Because what you see on CNBC, what you read in the financial press, that's just the surface. The real story is happening in the shadows, in the vaults of central banks, in the trading floors of institutions that manage trillions of dollars. Central banks around the world just completed their 24th consecutive quarter of net gold purchases. Think about that for a second. 6 straight years of buying. But here's what makes this different from every other buying cycle we've seen. The pace is accelerating. In the most recent quarter, central bank purchases hit levels we haven't seen since the early 1970s, right before gold went on its historic run. But it's not just that they're buying, it's who's buying and why they're buying. That tells you everything you need to know about where this is headed. The People's Bank of China has been adding to their gold reserves every single month for over a year. And these aren't small purchases. We're talking about tonnage that would have made headlines a decade ago. But now it barely gets mentioned in the financial press. Why? Because it's become so routine that it's not even news anymore. It's just what's happening. And China's not alone. Poland just announced they're targeting gold to represent 20% of their total reserves. 20%. That's a massive allocation for a central bank. Russia, despite being cut off from Western financial systems, has been accumulating gold at a pace that suggests they know something about the future of the dollar that they're not saying out loud. Turkey's central bank has increased their gold holdings by over 300 tons in the last 2 years. India's buying. Singapore's buying. Even central banks that historically held minimal gold are suddenly building positions. Now you might be thinking, okay, central banks are buying gold. They've always bought gold. What's the big deal? Here's the big deal. Central banks don't speculate. They don't chase trends. They don't buy assets because they think they might go up. Central banks operate on decade-long time horizons with access to economic data and geopolitical intelligence that you and I will never see. When central banks around the world simultaneously decide to accumulate a specific asset at an accelerating pace, they're not making a bet. They're preparing for something they know is coming. And what they're preparing for is a fundamental restructuring of the global monetary system. Let me take you back to a moment in history that most people have forgotten, but that's about to become incredibly relevant again. August 15th, 1971. President Nixon closes the gold window, effectively ending the Bretton Woods system and severing the last link between the dollar and gold. At the time, gold was trading at $35 an ounce. What happened next? Over the following 9 years, gold went from $35 to $850. That's not a 2,400% return. That's a complete repricing of gold relative to fiat currency. And it happened because the world realized that the dollar was no longer backed by anything except the full faith and credit of the U.S. government. Now, fast forward to today. We're seeing the early stages of another fundamental shift in the global monetary system. But this time, it's not about one country changing its policy. It's about the entire world simultaneously losing faith in the dollar-based system. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternative payment systems that bypass the dollar entirely. They're not talking about it in theoretical terms anymore. They're building the infrastructure. They're signing agreements. They're conducting trade in their own currencies. Saudi Arabia, the cornerstone of the petrodollar system for the last 50 years, just announced they're open to selling oil in currencies other than dollars. Let that sink in. The petrodollar, the system that has underpinned dollar dominance since the 1970s, is being openly questioned by the very country that made it possible. And what are all these countries accumulating as they build these alternative systems? Gold. Physical gold. Not gold ETFs. not gold futures, not paper claims on gold, actual physical metal that they're storing in their own vaults. Because here's what most people don't understand about gold. It's the only asset that's nobody else's liability. When you own a dollar, you're holding a liability of the Federal Reserve. When you own a bond, you're holding a liability of the issuer. When you own a stock, you're holding a claim on future earnings that may or may not materialize. But when you own physical gold, you own an asset that has been recognized as money for 5,000 years, and that carries no counterparty risk. And in a world where trust in institutions is eroding, where debt levels are at all-time highs, where central banks are trapped between inflation and recession, that matters more than ever. Let me show you what's happening in the physical gold market right now, because this is where the story gets really interesting. The premium for physical gold over paper gold has been widening. In some markets, you're paying 5 to 7% more for physical metal than what the futures price suggests it should cost. That spread tells you something critical. There's a shortage of physical gold relative to demand. The U.S. Mint has been rationing gold eagle production. They can't keep up with demand. Dealers are reporting wait times for physical delivery that we haven't seen since the financial crisis. And this is happening while the paper gold market, the futures and options traded on the COMEX, shows relatively modest price increases. What does that tell you? It tells you there's a disconnect between the paper market and the physical market. And historically, when that disconnect gets wide enough, the paper market eventually has to catch up to physical reality. Now, I want to talk about something that's relevant if you're sitting on significant retirement savings. If you have $100,000 or more in traditional retirement accounts, there's a strategy that more and more people are using to get exposure to physical gold within their retirement accounts without triggering tax penalties. I put together a free guide that explains exactly how gold IRAs work, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No pressure, but if you're concerned about the purchasing power of your retirement savings, it's worth understanding your options. All right, back to what's happening in the market right now. Let's talk about the supply side of this equation, because this is where things get really concerning if you're not positioned in gold. Global gold mine production has been essentially flat for the last 5 years. We're not finding major new deposits. The easy gold has been mined. The remaining deposits are deeper, lower grade, and more expensive to extract. And with energy costs rising, with labor costs rising, with environmental regulations getting stricter, the cost of producing an ounce of gold has been steadily climbing. The average all-in sustaining cost for gold miners is now somewhere around $1,300 an ounce. That means at current prices around $2,000, miners are profitable, but they're not making the kind of margins that would justify massive new investment in exploration and development. And here's the kicker. It takes 7 to 10 years to bring a new gold mine from discovery to production. So even if gold prices spike tomorrow and miners decide to invest heavily in new projects, we won't see that supply hit the market until the early 2030s. Meanwhile, demand is accelerating. Central banks are buying at record pace. Individual investors in Asia are accumulating. Jewelry demand in India and China remains strong. Industrial demand for gold in electronics and other applications continues to grow. You've got flat to declining supply meeting accelerating demand, and we all know what happens when that dynamic plays out in any market. But there's another factor that most people aren't paying attention to, and it's potentially the biggest driver of all. The commercial banks are changing their positioning. For years, the big commercial banks, the J.P. Morgans and the Goldman Sachs of the world, have been net short gold. They've been betting against it, or at least hedging their exposure. But over the last 18 months, we've seen a dramatic shift. The commercial short position in gold has been declining. In some recent reporting periods, commercials have actually been net long. Why does this matter? Because commercial banks don't take positions based on hope or speculation. They have teams of analysts, access to order flow data, relationships with central banks and sovereign wealth funds. When they flip from short to long, they're not making a guess. They're positioning for what they see coming. And what they see coming is a repricing of gold relative to the massive expansion of the money supply that's happened over the last 15 years. Let me give you some numbers that put this in perspective. In 2008, The Federal Reserve's balance sheet was about $900 billion. Today, it's over $8 trillion. That's almost a 900% increase in the monetary base in 15 years. The M2 money supply, which measures the total amount of dollars in circulation, has gone from about $8 trillion in 2008 to over $21 trillion today. We've created more dollars in the last 15 years than existed in the entire history of the country before 2008. Now, gold hasn't kept pace with that monetary expansion, not even close. If gold had tracked the growth in the money supply, it would be trading somewhere north of $5,000 an ounce right now. Instead, it's at $2,000. That gap, that disconnect between the expansion of the money supply and the price of gold, that's what's going to close. And when it closes, it's not going to happen gradually over decades. It's going to happen in a compressed time frame that catches most people completely off guard. We saw this exact pattern play out in the 1970s. From 1971 to 1976, gold went from $35 to about $120. A nice move, but nothing spectacular. People who bought gold in 71 were probably feeling pretty good about their 300% return. But then, from 1976 to 1980, gold went from $120 to $850. The real move, the move that created generational wealth, happened in just 4 years. And it happened because the market suddenly woke up to the reality of what inflation and currency debasement actually meant. We're in a similar setup right now. Gold has been in a long, grinding uptrend since the lows in 2015. It's made steady progress, but nothing that's captured mainstream attention. Most people still think of gold as a boring, old-fashioned investment that doesn't do anything. But beneath the surface, all the same conditions that preceded the 1970s gold bull market are lining up again. Massive monetary expansion, rising inflation, declining faith in fiat currencies, geopolitical instability, central bank accumulation, supply constraints. The only question is timing. And while nobody can predict exactly when the market will wake up to these realities, we can look at the catalysts that are likely to trigger the next major move. One potential catalyst is a currency crisis in a major economy. We've already seen the British pound and the Japanese yen come under severe pressure in the last year. If one of the major currencies experiences a full-blown crisis, it's going to raise questions about all fiat currencies. And when people start questioning the stability of their currency, they don't rotate into other currencies. They rotate into gold. Another potential catalyst is a sovereign debt crisis. Global debt levels are at all-time highs. The U.S. alone has over $33 trillion in federal debt, and that number is growing by about $2 trillion a year. At some point, the market is going to start questioning whether this debt can ever be repaid in real terms. And when that question gets asked seriously, gold is going to be the answer. A third potential catalyst is a major geopolitical event, a conflict in the Middle East that disrupts oil supplies, a confrontation between major powers, a breakdown in the global trading system. Any of these events would send investors rushing into safe haven assets, and gold is the ultimate safe haven. But here's what's interesting. We might not need a major catalyst at all. Sometimes markets just reach a tipping point where the fundamentals become so obvious that the price starts moving on its own momentum. We saw this in 2010 and 2011 when gold went from $1,100 to $1,900 in less than 2 years without any single dramatic event triggering the move. The market just woke up to the reality that central banks were printing money at an unprecedented pace and that gold was undervalued relative to that monetary expansion. We could be approaching a similar tipping point right now. The fundamentals are arguably even more compelling than they were in 2010. The monetary expansion has been even more extreme. The geopolitical risks are higher. The supply constraints are tighter. Central bank buying is more aggressive. All we need is for the market to start paying attention. And when the market does pay attention, when gold starts making new all-time highs and holding them, when it starts appearing in headlines and on financial news networks, that's when the real move begins. Because that's when the momentum traders get involved. That's when the institutional money that's been sitting on the sidelines starts allocating. That's when retail investors who've been ignoring gold for years suddenly decide they need exposure. And that's when supply and demand dynamics get really interesting. Because unlike stocks, where companies can issue more shares or bonds, where governments can issue more debt, you can't just create more gold. The supply is what it is, and when demand surges, the only way the market can clear is through higher prices, much higher prices. Now, I want to address something that skeptics always bring up when you talk about gold. They say gold doesn't produce cash flow. It doesn't pay dividends. It just sits there. And they're right. Gold doesn't produce cash flow. But here's what gold does do. It maintains purchasing power over long periods of time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same thing about the dollar? A dollar today buys about 3% of what a dollar bought 100 years ago. Gold isn't an investment in the traditional sense. It's insurance. It's a store of value. It's a hedge against the debasement of fiat currency. And in an era where every major central bank in the world is actively debasing their currency, that hedge is becoming more valuable by the day. Think about what's happened to your purchasing power over the last few years. Your grocery bill is up 30 to 40%. Your energy costs are up. Your insurance premiums are up. Your rent or mortgage payment, if you're buying now, is dramatically higher than it was 3 years ago. The official inflation numbers say inflation is running at 3 to 4%, but your lived experience tells you it's much higher than that. And the reason for that disconnect is that the official numbers are manipulated to understate the real rate of inflation. Gold doesn't lie. Gold reflects the real rate of currency debasement. And right now, gold is telling you that your currency is losing value faster than the government wants to admit. So, when people say gold doesn't produce cash flow, I say that's exactly the point. Gold doesn't need to produce cash flow because it's not being debased. Every dollar you hold is being debased by about 7 to 10% a year in real terms. Every share of stock you own is denominated in a currency that's being debased. Every bond you own is a promise to pay you back in a currency that will be worth less when you get it back. Gold is the only major asset that escapes that dynamic. And in a world where currency debasement is accelerating, that makes gold not just relevant, but essential. Let me tell you a story about a man named John Paulson. You might remember him as the hedge fund manager who made billions betting against subprime mortgages in 2007 and 2008. After that trade, Paulson could have retired. He'd made more money than most people could spend in 10 lifetimes. But instead, he took a significant portion of his wealth and put it into gold. Not gold stocks, not gold ETFs, physical gold. And he did it in 2010, when gold was around $1,200 an ounce. People thought he was crazy. Gold had already had a good run. It seemed expensive. Why would one of the smartest investors in the world put so much of his wealth into a metal that doesn't produce cash flow? Because Paulson understood something that most people didn't. He understood that the response to the financial crisis, the massive monetary expansion, the zero interest rate policies, the quantitative easing, all of it was going to lead to currency debasement on a scale we'd never seen before. And he understood that gold was the best way to protect wealth in that environment. Gold went from 1,200 to 1,900 over the next year. Paulson made billions. Again. Now, I'm not telling you this story to suggest that you should put all your wealth into gold. I'm telling you this story to illustrate that the smartest money in the world, the people who have access to the best information and the best analysis, they understand the role that gold plays in a portfolio during times of monetary instability. And we are living through the most extreme period of monetary instability in modern history. The question you need to ask yourself is this: 5 years from now, 10 years from now, when you look back at this moment, are you going to be glad you positioned yourself for what was coming? Or are you going to be one of the people wondering why you didn't see it? Because the signs are all there. The central banks are telling you what's coming through their actions. The commercial banks are telling you through their positioning. The physical market is telling you through the premiums and the supply constraints. The geopolitical situation is telling you through the breakdown of the dollar-based system. The only question is whether you're paying attention. Your future self, the version of you that exists 5 or 10 years from now, is going to look back at this moment. And that future version of you is either going to be grateful that you recognized what was happening and positioned accordingly, or they're going to be frustrated that you had all the information you needed and didn't act on it. The choice is yours. But the window to position yourself before the crowd figures this out is closing. Not tomorrow, not next week, but it's closing. And once the momentum really kicks in, once gold starts making headlines and breaking out to new highs, the opportunity to buy at these levels will be gone. This isn't about timing the perfect entry point. This isn't about trying to catch the exact bottom. This is about recognizing a major structural shift in the global monetary system and positioning yourself on the right side of that shift before it becomes obvious to everyone else. Because by the time it's obvious to everyone else, the easy money will have already been made.